about that inflation stories, Nikki. So December inflation lower than expected. That's the strongest demand month. That's also the Odette month. What's going on here? Is that a good sign or is that a bad sign that there was no demand-driven inflation, or also that the effects of inflation are going to be lagged and we might have a difficult first quarter in terms of consumption?
Yeah, well, two points that you made there. First is there's a story that the demand pressure has been soft in 2021. Well, it has been improving because of the economic reopening, but demand pressures remain still relatively soft to previous episodes. So even if we had all this revenge spending, all this eating out and all that, demand pressures were unable to really push inflation much higher. So only a 3.6%, back within target. And just the entire dynamic of the supply side driven inflation numbers of last year sort of really highlighted there. But one thing, I was actually expecting a much higher number because I was forecasting food prices to go up. And it just tells us that maybe the impact of Odette, the 10 billion agricultural damage, is going to be sort of logged back or logged forward to January 2022 and maybe February 22. So despite the 3.6%, the sort of surprise on the downside for inflation for December, we might see slightly higher prints in the first quarter of this year. So yeah, as some people were indicating that there would have like a delayed impact.
Okay, and plus you've got elections on May. Is the spending going to be, inflationary, or is that going to actually spur growth? What impact is that going to have on the economy? And if so, do the policies really matter at this point in time when we talk about sustainable recovery?
Yeah, well, first on inflation, I think for the most part of this year, we could see inflation a little more subdued, a little more, benign, maybe not down to 2%, but right at the 3%, maybe slightly above the 3% handle for inflation this year. Several things happening. We have the CPI rebasing by the PSA. PSA is clocking forward the CPI base year to 2018. Because of what happened in 2018, we saw extremely high inflation numbers back then. Base effects will keep inflation pressures, or at least the headline number, look a bit more subdued for this year. Secondly, you're seeing OPEC starting to pump more oil. They have agreed to increase supply given the tight market conditions. That should help ease global crude oil prices, and that's also going to translate to lower inflation here in the Philippines. Now, on the election-related spending, yes, that should have that should fuel some demand pressures on inflation. Growth-wise, I think it's going to be, of course, it usually is a positive. And there are two things that drive the boost during election years. First off is, of course, your consumption numbers. There's more money changing hands, so consumption tends to get a boost. But one other thing that people always tend to miss is that it's public construction that usually drives this push. Maybe congressmen or politicians who are trying to finish off their budgets ahead of the polling time. So maybe we start to see more infrastructure projects completed, and that of course drives growth in those areas. In one thing that people also don't mention is that after the election season, let's say the second half of the year, government spending does tend to dip quite substantially. After a new administration takes over, you get new people coming in. The cabinet will most likely be changed up. So you're going to see, the learning curve for officials to take root, take some time for spending, at least from the government side, to kick up again. So I think that's one thing we have to sort of be watchful for, is that government spending has been supporting GDP for the past 2-3 years. All of a sudden that disappears, we could see some, that could weigh on overall GDP this year.